So what we have here is the statement of stockholders' equity. This is probably the least useful of the financial statements, but still, I want you to understand what it means and what it's telling you, because it gives you insights into how companies are financed and how stockholders' equity works. The idea of stock is that a share of stock signifies ownership in the corporation. So typically when you buy stock, there actually is stock. It's a certificate. And what you'll do is you pay money to the company and they give you stock certificates to represent that ownership. So you hold these stock certificates and that means that you own stock in the company. If you want to sell them, you'll sell the stock certificates over and give them to the new owners and they will give you money. There's two ways that this can be done. One way is through the company and one way is outside the company. You can buy stock directly from the company. This is usually in an IPO, an initial public offering, or it can also be if you're an employee of the company and you buy stock options. So when you exercise those stock options, basically what you do is you give the company money and the company gives you shares of stock in itself. Now if you call a broker to buy stock, you're usually not buying it from the company, usually buying it from another stockholder. So what the broker does is find sellers and buyers and matches them together. And this is usually done through a stock exchange. So the broker used to tell the broker you want to buy 1,000 shares of General Motors. I don't know why you would do that, but let's say you're going to do that. And the broker will find 1,000 shares for sale and buy them and then sell them to you at whatever price is mutually agreeable. So you're actually buying the stock from another stockholder. You're not buying the stock from the company itself. Contributed capital then is stock which was purchased directly from the company. So when the company does, let's say, an IPO, an initial public offering, or a later public offering, what the company is really doing is that's the point where the company sells the stock to stockholders. And all of the proceeds from that become contributed capital. Now, anytime the stockholders subsequently sell to other stockholders, that's not the company, that money doesn't come into the company, it's just exchanged between the different stockholders. So contributed capital is capital that was invested in the company by stockholders, and those stockholders may still be stockholders or they may have sold to other stockholders. The company will keep track of who its stockholders are because it needs to know who to pay the dividends to. But this is the initial investment that stockholders made. Yes, you had a question, Harvey?
Is it impossible for individual to buy stock from IPO?
I'm not a finance professor, so I can't tell you that. But usually if you have a relationship, if you have a relationship with a broker who's able to buy the stock in the IPO, then you may be able to. There's a lot of controversy over whether IPOs sometimes can be hard to get. So there's a lot of controversy. There's people who claim that people can't get into IPOs and therefore are deprived of the ability to profit from them. So there's been a lot of, that's just been going on as long as there have been IPOs almost. So supposedly brokers are selective in who they give them out to, and that they shut out some investors. But
Just have a relationship with brokers firm and get profit.
yeah, I don't really know. I don't know enough about it, so I'm not gonna, I'm not gonna spout on. But my understanding is that if someone's a small investor and they don't have a good relationship with a broker, that it would be hard for them to get into an IPO at the base price. Lately, there have been a few IPOs where, it would be better off waiting anyway. The price just goes down after the IPO anyway, so what's the big deal? But I don't really know, to tell you the truth, but I've heard that. Retained earnings is, again, income that was kept in the company. It was income that the company had that was not distributed as dividends. Remember what dividends are. Dividends are distributions of profits. So if a company has profits, there's one of two things it can do with those profits. It can give them to the shareholders as dividends, or it can keep them inside the company and use them to grow, to buy assets, or just to hold on to money. Retained earnings are the income where the company chooses to hold on, and then other equity. So these two pieces, contributed capital and retained earnings, really comprise the base of, these are really the two main types of stockholders' equity that you can have. One other thing that I want you to notice here, and this is the formula for retained earnings. And the formula is, and it's a golden thing to know, beginning retained earnings plus net income minus dividends equals ending retained earnings. Right there, key formula. And you can see this here right in the statement. We have beginning retained earnings in this column, plus net income, minus dividends, equals ending balance of retained earnings. Real important formula. So now, once again, take a minute and review what we just did. All right, so earnings is another word for net income. Earnings of a corporation belong to whom? The stockholders. The managers, what belongs to the managers? Yeah, whatever their compensation is. Earnings can either be distributed to the stockholders as dividends or kept in the business as retained earnings. Income statement formula is revenues minus expenses equals net income. Balance sheet is assets equals liabilities plus stockholders' equity. Stockholders' equity equals contributed capital plus what? Plus retained earnings, plus other items. Statement of stockholders' equity is beginning of retained earnings plus what? Net income minus dividends equals ending retained earnings. Net income is computed where? Now this is where we get to the cool stuff. Net income is computed on the income statement, and then it's transferred to the statement of stockholders' equity to increase what? Retained earnings. It's the same number. Ending retained earnings is reported on the statement of stockholders' equity, and then it gets transferred to which? The balance sheet. And if you don't buy this, then look at what we just did. We have the income statement here. Net income was $63.20. $63.20 goes onto the statement of stockholders' equity right here. $63.20. Then ending retained earnings is $37.090. Right there. That goes to the balance sheet, wherever it is, right here, $37.90. Isn't that beautiful? It's nice, they all fit together. And every company is like that. Everyone. If it's not like that, there's a mistake. Because what income belongs to whom? Stockholders. Right? So if your income, it goes to the stockholders' retained earnings, and then it goes into stockholders' equity on the balance sheet. That's what belongs to you, the stockholder. Now let's practice a little. Which financial statement does each one of these appear on? Contributed capital appears where? The statement of stockholders' equity, and also the balance sheet. In the balance sheet, it appears in what section of the balance sheet? There's assets, liabilities, and stockholders' equity. Stockholders' equity on the balance sheet. Net income appears where? Income statement and stockholders' equity. Income statement is at the very bottom, right? Stockholders' equity statement, it goes in as an addition to retained earnings. How about dividends? Where do dividends appear? Stockholders' equity. And where does it appear on the statement of stockholders' equity? Under retained earnings. It's subtracted from retained earnings. And how about retained earnings? And the balance sheet. So it's at the bottom of the year-end retained earnings is at the bottom of the statement of stockholders' equity, and then it goes to the balance sheet, as I just showed you. Sales revenue goes where? The income statement. Accounts receivable goes where? The balance sheet. How about what kind of item is it on the balance sheet? Asset, liability, or stockholders' equity? It's an asset on the balance sheet. Wage expense is an expense on the income statement, and bonds payable is a balance sheet item. Use PepsiCo's 2010 Statement of Stockholders' Equity above to answer the following questions. Contributed capital reported at the end of the accounting period is how much? $4.449 billion, which is the amount of that shareholders paid for issued shares. That's the amount of money that stockholders put into the company when they received their shares of stock. Retained earnings increased by what? It's increased by net income, and it's decreased by what? Oh, net income of, they won the amount here, is $63.20. And it's decreased by what? By dividends of how much? $30.41. It's $3.041 billion. When a company issues shares of stock, total stockholders' equity increases or decreases? Increases. And when the company buys back shares of stock, total stockholders' equity decreases. Beautiful.